Welcome to Smashed Avo Property. Today I'm speaking with Rasti, and boy does he have some credentials. Rasti has had 3 major careers all in separate industries, studied all over the world including having a Masters of Computer Science, being an MBA and completing his CFA. And today he walks us through how all of these previous experiences had led him to build a personal portfolio of 15 properties, and has now driven him to help show others and guide others on how to do it themselves.
For example, like if I'm holding a big 2 rich assets of properties, in northern beaches or eastern suburbs. Now the challenge is that if one tenant leaves the property, all of a sudden I have a 50% vacancy rate in my portfolio of 2 properties. Whereas when I have 10 properties, even when 2 tenants leave at the same time, which is probably unlikely based on the statistics, even if 2 people leave together, there are 2 vacancies in my portfolio, that is still only 20% vacancy because I still have tenants in my 8 properties.
So without any further ado, let's get house hunting with Rasti. Rasti, welcome to Smashed Avo Property.
Thank you so much. Thanks for this opportunity.
Mate, a good friend of the podcast and a good friend of both of ours, Mike Moorclock, passed on your contact and said you've got some really great insights. And I've been fortunate enough to jump on a phone conversation with you a couple of days ago and run me through your backstory. And I'm very keen to share your story with the listeners and especially what you do and with your workshops and all that sort of stuff. So for the people who don't know you, do you want to give us a little background about yourself and what you get up to?
Sure. No, first of all, it's an honor to be here talking to you and as well as reaching out to your audience. So thank you so much for having me on board and talking to you and your audience. Very quickly, I'm Vaibhav Rastogi. People like to call me Rasti. It's easy to remember as a name, my nickname. I hail from India. I came here in Australia about 14 years ago. Haven't really looked back. Have been investing in properties. My background wise, I've done few qualifications. So pretty qualified and very confident what I'm doing now. And that actually helps me do what I'm doing now, which is basically helping people build portfolios. So not just talking about our property, but building portfolio for us to get ahead of our financial well-being in our journey. So that's what I do. My business name is Get Rare Properties. So Get Rare is more of an acronym for Get Rich and Retire Early. And that is actually what I do, like helping people to build wealth so that they can retire early and pursue their passions.
Yeah, that's awesome. And when we talked the other day, you got quite an extensive background at university and studies. You want to walk through the listeners a bit of that story?
Sure. So I have been always passionate about properties from childhood. I enrolled myself in engineering college with a specialization in architecture. So I'm an architect, but it was changing circumstances that I had to change my career. Moved into IT, so became more of a data person. Worked on a lot of information systems. I got my master's in computer science. I was doing great, enjoying what I was doing. Then, because I was making money through my investing from share market and properties investing, and I realized that the money that I make in my investments is not only taking less of my time, but is more rewarding. And I realized that if I'm able to do this on my own, how good it would be if I can actually learn from the best in the breed and learn and execute it. And serving the purpose of helping others, I thought like making money is what I really want to do. So I let go everything. I took sabbatical, or rather went for a full-time MBA, went to UNSW in Sydney, and then later on to Chicago, US, to pursue my Master's in Business Administration, MBA, with a specialization in finance. Of course, just by changing, like going for MBA doesn't really get you in a finance role. So I had to do a Chartered Financial Analyst, which is a CFA designation, one of the best in investment management world. So I pursued that, and combination of my MBA and my CFA got me in a role in Big Four bank working as an investment manager. So in my last role, I was actually managing money in tune of $2 billion directly under my management. So it was pretty awesome what I was doing. I really thoroughly enjoyed it. It's just that I found a bigger purpose for me what I'm doing now. So yeah.
Yeah, I love this. I love that you've got such an extensive background, and So many degrees under your belt. Like I love that. No wonder you and I get on because you've got the computer science background. You're an architect as well, or studied to be an architect. Like it's phenomenal. And you can sort of see how all of these degrees have sort of transfixed into where you are now, even the CFA side and working for a big bank and managing large amounts of money and understanding how that all works and bringing that to the property sector. So yeah, you obviously got a ton of information in that head of yours, and I'm really keen to share it with the listeners. But at what point did property come into play? Was it at the start of did you start investing when you were really young, doing your first degree? Like how did that sort of transition?
Yeah, so it actually happened about 16 years ago. In 2004, the year I got married, we realized that we are spending a lot of money. And so the typical balance sheet was like we earned money, we spent money, and whatever was left, we were saving. And we realized that because I was kind of a person with research and trying to take some advices from people who have done it much better way before me. So the advice that I got from the books and the people around was that we have to make a plan of forced saving, and nothing beats a regular mortgage on your head when the system turns around, and it's more around the lines of you save, you earn money, then you save, and then whatever is left you spend on it. So that was the idea. So within my first year of marriage, when things were pretty much obvious, like where we are heading towards, so we got ourselves a mortgage. So not a home, but a mortgage. So that's what I look. It was more of a forced saving, and that has got very much into property straight away.
Yeah, that's great. I think that's a common one where people are like trying to park their money or trying to park their savings into an asset at least. It's an Australian dream. It's, we've got property running through our veins in Australia. So it's a pretty common one. And then from that, how have you seen, I know the size of your portfolio because you told me it the other day, but for the listeners, how did you transform that into what you've grown into today?
Sure. So as I shared earlier, I am an owner of 15 properties, built over 7 years of span. So the property that I just talked about, I bought, actually was in India, but I started investing in, I started investing in Australian market in 2011. And so I had a plan, I had a strategy to build a portfolio up to $5 million, because I'm very much of a firm believer that there has to be a plan, there has to be strategy, and then it's more about being consistent and persistent in that approach. So I envisioned myself having a plan, having a goal, and working it backwards. I came to the number that I have to build a portfolio of $5 million. And within 7 years, I was luckily able to achieve that. And since then, so since 2017, I'm not really added on to my portfolio because I'm just following a plan that, okay, now it's just a matter of deleveraging it. So let it grow and then consolidate it and get them mortgage free. Because at the end of the day, it's not the properties that matters, not the size that matters. It's more about what it is doing to the cash flow at the end of the day.
Yeah, that's the dream that everyone gets into it, isn't it? Is to build up the portfolio, pay them down, and then have the cash flow coming through. And it sounds like you're well on your way. How was the Indian market? Like, is it completely different? Is it the same sort of process? How do the banks work over there? I never really asked anyone that question.
And sure, no, it's entirely different over there. It's not that, I guess, straightforward over there. It's more like things happen behind the scenes as well, and you have to be super careful. You have to have a man on the ground in the sense that they can overlook the property. So the easiest bit over there is to buy a property which is in the development stage. So what it means is that we are dealing with a developer who's a big entity, a corporate level. So it's kind of a off the plan purchase whereby we pay the deposit, and or maybe what do you call it, as a structured schedule of the payment that we keep paying. And once the construction is complete, when it is handed over, then we have to worry what's really we have to do there. Typically, I've chosen to leave the properties vacant instead of taking the risk of the tenant taking over the property. So it's not really straightforward over there. And that's the reason why I actually like Australian market more than relatively speaking, Indian market.
Yeah, just sounds a little bit over different.
Here is legally, yes, it's like you can de-risk over here in a much better, much more certain way. than otherwise. Yeah.
Yeah. Okay. Interesting. And were you able to like leverage any equity or anything off that Indian property over to Australia, or did you have to start from scratch over here?
Oh, I started from scratch over here.
Yeah.
All it gave me the confidence that I can go big over here. Or I think as you can appreciate that two parts of it. One is the mindset, like what you want to do, how you can do it, and then B, getting to know the know-how of doing that. So I had the mindset of investing and making money work for me. So that was pretty easy bit for me personally, which I feel that people actually get stuck on that. Once you know your why, once you know what you want to do, as like what you want to achieve, then it's more about finding the ways to do it. As we say, like where is will, there's a way. So I had the will and found the way over here. Like I spent so much time, energy, and money to get myself educated. And when I started just on that, like when I started looking for a property in 2011, I actually waited for maybe 14 months just to figure out what to do or how to do in Australian market context. Not that I actually did a big portfolio back in India. It's not like that. It's just that it gave me an exposure that how we can borrow money to make money, as in it's more of a leveraged money that you can make it work for you.
Yeah, using leverage.
I started from scratch.
Yeah, no, that's awesome. And I'm curious about like considering you're following your passion now and doing what you love every single day and providing that education piece to so many people that need it. Do you value your university degrees to the extent like how it's gotten you through your career, what businesses you've gone through, going to a major bank and having all that experience? Do you think that's still extremely valuable and transitioning to what you're into today? Or if you could turn back time, would you go straight into what you're doing today?
No, I believe that what I've actually gone through has actually helped me in every sense to do what I'm doing today. So just running through my careers or my industry that I have been as an architect, like to me, property, a 2D plan versus even if you walk through, it's entirely different. I guess my gauge, like the way I look at the lens that I use, because I've designed myself. So I know how spaces work, because it's more about the appeal to the people. Like though we say property is bricks and mortar, to me, it's still about people. Like supply and demand based on, at least that demand is based on how people perceive the value of the property. Even the space, of example, like how functional the design is, like how much productive the spaces are, will define the usability of the property or the area or the space, the volume. So that has actually helped me a lot to visualize. To me, these are the spaces as compared to just the rooms or as in the 2D plan. So that's one bit. Second bit is like when I went to the information systems as an IT industry, where my focus was more around database information systems. To me, what I have been doing now is like I'm very much data-driven person when it comes to the research. I'm not really just thinking that, okay, how do I feel about the design or how do I feel about the evaluation? I actually get to the bottom of it, like why or how a component of a property, so for example, swimming pool in the vicinity or like within the neighborhood, how much is it valued? Right? So of course, I'd run different various ways of valuing the property. So one way is doing the comparable sales. It's an art and a science at the same time. So I rely a lot on the data. So having an understanding, running my own models, like forecasting models, tracking systems of my own, like I've actually built on my own. And of course, like I've used Python as well at one time, whereby we were talking about like how we forecast the growth based on the data that we have. So I actually got into the artificial intelligence side of things as well, like putting it as a black box. And it's fun, like we have come up a long way from the information systems. Now it's more of a data predictability. Like we are having automated cars like driving through the road. So that is what I'm actually doing in my data research and predicting the market. It's not there yet, so can't really talk too much like where I am, but it's a work in the progress. When it comes to my third career, which is investing, it's all about rewards, returns people think about. To me, the first thing that comes to my mind is risk, because risk and reward are two sides of the same coin. And whenever we are talking about risk, which are defined as an opportunity of expected, or like it's expected return that we can expect, we have to also think in terms of probabilistic model. Like, what if we don't really go on a bullish mode from here, but go bearish? How do we put it together? In a property, this is very simple thing that I'm just talking about, but the key thing that I actually learned in my investing world, where managing $2 billion was all about convincing the board members that why we should invest in one asset this much amount. It actually opens up a lot of philosophies, a lot of theories around how we can go and make it as a portfolio rather than individual assets. So to me, when I'm helping people build portfolios, I think of a particular property to serve me a purpose. So what I mean by that is, like, maybe with the analogy, if I can, it's like putting up a team together for cricketers. So I won't really go like for all 11 all-rounders. I would rather say, okay, what is my specialist batsman? Who is my specialist bowler of this type for this particular environment, as in for against this particular team? So I put that kind of a portfolio theory in selecting of the properties. So the essentials of risk and portfolio are the key things when it comes to the lessons learned from my investment industry. And at the end of the day, Jordan, we are talking about building wealth. And building wealth is all about investing. And there are lots of theories, lots of things comes to mind. And also understanding the risk appetite of people, the current circumstances and where they want to be. And that's what I actually deploy as well as my philosophy, because we are designing something for individual. So financial planning is the key element that I take into account. So in my conversation with anyone, property is probably, third or the fourth topic that we are talking about. We are still talking about, in my first few sessions, we are talking about what do we want, where we want to go. Are we okay to take that kind of risk? What's the mindset that we are talking about? Debt, people are so scared sometimes, but just like any other thing, like everything has a good aspect and bad aspect of it. So if you take just like cholesterol, like if it's high, like it's a good cholesterol, high is good. So same thing, like let's not get scared about cholesterol unless we qualify them or classify them in bad or good. So same thing with debt, as you know. I'm a big fan of Robert Kiyosaki theories that what he talks about, which I'm pretty sure you and the audience is very familiar with. So debt is good if it is for an asset. So having that kind of structure, having that kind of conversation, along with my own portfolio, talking about 3 topics, 3 subjects, 3 careers: architecture, IT systems, and investing, along with my overarching portfolio and being able to walk the talk. I feel that I'm pretty qualified to serve that kind of services and help my clients and family and friends along with me to go further in our journey.
Yeah, 100%. I think, you can see how all 3 careers have really tied this whole process in together for you. And you've got so many fundamentals and understandings of the whole process of not just investing, but really starting with your why. And I think, you've touched on that a few times. So if a client was to come to you, let's start with the process. What does the process look like? What are some of the questions that you'd ask about their why? And what are some of the responses and tracks that you'd like to go down with a particular investor?
Sure. First of all, I'll start the disclaimer that everyone is not at the same starting point. Like, they are different in their level of journey that they've already taken, their own risk appetite, their own understanding of financial freedom. What does that mean? People sometimes even don't really know what that means. Like, if I talk to someone like getting retired, like, no, I love my job. What do you mean by retirement? Kind of thing. So it comes with a very basic, like it's a very consultation approach that I take. First question is like, okay, where are you today? Like, what do you in your life? Like, like in terms of what have you been doing since last few years, and where do you see yourself in the next few years if you don't do anything? Like, what's your status quo? Then the question is like, are you happy with that? Like, do you see, where you are today? If you keep continuing, extrapolate on where we are with the journey. Of course, we are all progressing. So if you extrapolate that progress, do we think that we are making the cut of being happy and satisfied? To me, everyone is struggling with, not everyone, I take it back. Most of us are struggling with our money and time along with the energy. So it's a combination of three that we really need all the time to be able to enjoy life and pursue our goals or pursue our passions. It's just that we feel so constrained around the challenges of life that we have actually kind of given up on our passion. Like I start with the question that, okay, when you were a child, what desires you had? Somebody might say that I wanted to be a painter or a singer, writer, author. And the next question is, okay, why you're not doing it today? And are you happy of not being able to do it for next few years in your journey? So idea is basically making them realize where they are in their journey themselves. I'm just posing the questions, for making them realize that, if at all, not everyone is there same, so don't get me wrong. Everyone is, somebody might be there, might be much higher in their level. But for me, it's more of an intriguing questions of the essence of existence and the purpose of living. And like, for example, like for young adults or young family members, we really want to spend time with our young ones because we know, as a parent of two kids myself, we know time flies very quickly. So how do we go and, cherish those moments with them without really worrying too much about our future or our career? So that's how I start. And then I talk about property investing. Like I talk about my own journey, where I was 10 years ago, how I built my own portfolio, and would that be something they will be keen to consider? And gauging their interest, gauging their risk appetite. That's when we start talking about, like there will be lots of questions on the way, like why property, or what if this goes wrong, or what that goes wrong. And as I said, Jordan, that we just can't really hope for the returns without really taking into account the risk, underlying risk around it. So I talk about my own strategies about risk, like what everyone should be talking about, not just related to properties, but also about their life. For example, human capital is the most valued thing in our portfolio as young, young in our careers. Have we actually ensured that by having our income protection? So having that kind of discussion around that, like people say, most of the people I actually come across, they say, oh no, yeah, my super has income protection. But my question to them, do they really know what it actually means? Because it can only cover them only for 2 years. What happens in the third and the fourth and the following years, So having that kind of financial planning element to my discussions, and property is just a way to achieve that financial freedom. I'm not saying use only property. So to me, again, coming from a financial background, it's all about diversification of assets. And when it comes to properties, then diversification can be on a very multiple kind of ways that we can do it, whether it's for demography, for location, type, budget, and even the type of the property, whether it's a unit or a house or landed properties, and then talking about strategies out there. So it's just a bit of journey. Like there's no one size fit all kind of thing. Like it's more of a consultation approach that I take.
Yeah, no, I love it. I think you've covered, and I love how you said not everyone's in the same position, and they're not. Like they're all starting at different sides, and you might find that like, someone wants to get into investing because they do want financial freedom. Like they don't want to be working their job and, retire at 65. They want to actually, might be able to retire at 45 if they start investing now and be able to pay off their houses at that age or whatever it might be. But then along the journey, as you say, they might have kids, and then they might realize, well, it's not really about the money as per se. It's not really about the financial freedom. It's more about giving me more time to spend with my family, giving me more time to do the things that I want. And you can actually see their journey transition, or their reason, their why reason transition throughout their life. And I think one thing that you touched on the other day when we were talking, which really resonated with me, is being a buyer's agent. It's sometimes it's common to view a buyer's agent as someone who just buys one property for one particular person. And I think one thing that really got me with you was that you said, look, I'm here to build a portfolio. I'm here to walk you through that journey. I'm here to buy, 6 properties, 10 properties, whatever your goal is throughout the process. It's not just a one-off purchase that, I'm going to get the commission and move on. You're actually there throughout the journey and there to help them build their portfolio and get them ready for the next stage and, buy under market value. And I think you were even telling me about a story the other day, how you were able to use, LMI and keep a solid amount of money in a particular client's savings. And then within a couple of months, the property had grown in equity. You could refinance and then go again straight away because of the way you positioned the transaction. So talk to us a little bit about how that journey looks for you throughout the process.
Sure. It's a huge question. So let me know if I've actually missed on any of the aspects there. So I'll try my best. So rightly said that I'm not just about a property. So if somebody wants to just talk about a property, probably I'm not really the right person. That's a disclaimer. However, who am I is more about the financial freedom. It really depends on the individual, how they define it. From my consultation approach, I'll help them define it because this is the conversation I do on a daily basis. And of course, as I said, property is a way to get there. So if somebody wants to achieve financial freedom by investing in properties, I can potentially help from my knowledge, from my experience, from my exposure, and from the education that I have behind me. How do I do that is I'll probably share some statistics which you probably are very aware of, is that 72% of property investors hold only one property. Other 18% hold other second property. So essentially 90% of property investors hold only 1 or 2 properties. And it's only less than 1% of property investors who hold 6 or more properties. Now, if I go back to that statistics of 90% holding 1 or 2 properties, my question is like, what is that doing to their balance sheet? Typically 5, 10, 15, 20 grand at most, they are getting out of that on an annual basis. That is not going to change the lifestyle. I mean, it can certainly improve it. Like I can potentially, with that money, 10, 15 grand in my pocket on an annual basis, that translates into a grand per month. I might actually go out a lot more on the Friday evenings with my family for a restaurant, or might go more frequent on a trips, like a weekend trips. That's not really serving the purpose, because the purpose of property investing or financial freedom is that it gives you the choice, the freedom to choose what we want to do. So I'm talking about changing the lifestyle, not just improving it. That's where the portfolio comes in. Because what the statistics says is that we need 6 or more properties to be able to change our choices on regards to what we want to do. For example, like if I talk about myself, like until last year, I was thoroughly in love of my job, what I was doing. I still do, like, managing money. It was a great responsibility. It's a very rewarding from the perspective that you're able to make an impact on people's lives, like when the investment grows. However, my own portfolio, property portfolio of $5 million, gave me a choice that what can I do instead of that job of my, like a corporate job that I was in. So that gave me kind of a choice, like what do I want to do? Had I stuck to my previous role, nothing wrong with that because it's my choice. And what I really want to offer is that choice to the people by achieving that financial freedom. What they do with that, it's up to them. So it's a journey as well. Like I'm not really the one I'm saying that give me money, invest in me. And then we go into, after X number of years, we'll get this. To me, what I'm saying is that let me help you in your own journey. As a client of mine, you are the one bearing the risk. You are the one bearing or enjoying the rewards of that. I'm just coming as a friend to handhold you, educate you, and take through the journey. I'll probably hold you back if you're taking a wrong step. So it's like I've done things on my own. Again, going back to my qualifications, my experience, I will be able to help. So that is what I'm talking about. Through when it comes to specifically asking them questions, it's more about, okay, what is the amount of passive income you want to generate for you to feel confident that you have a financial freedom. So start with that number. To me, the end goal in mind, what we have is our starting point in that journey. Somebody might say, look, I'm pretty low maintenance person. All I need is 50 grand per year. That will give me a lot of courage and freedom to do whatever I want to do. Somebody might say, no, 200K is probably about right. So there's a vast range. And to me, it's like, okay, so that's okay. That's good. Whatever it is, like there's no kind of questions on there or any sort of judgment on that. It's just that I show what people talk about, what should be the typical asset base for people to retire, not just financial freedom, but also like to retire, like what sort of numbers we're talking about. And that's coming from my own background of financial planning, because in my banking role, I was actually helping the financial advisor. So I was in a research advisory. So I used to sit with private bankers. They were talking to high net worth individuals. And the whole thing that I learned from those conversations was to have a very good clarity, not only the vision, but also the journey, the milestones that would help us to evaluate our journey. Like, are we on the track or not? So having an end goal in mind, having understanding where they are today and where they want to be, and then having a kind of a mapping around there. And Jordan, as we know, a planning is incomplete when it comes to property investing without really taking into account the leverage story or the leverage strategy, because banks are our best friends here. So I have built my own team around it, like qualified people who have worked only not just to get a loan, but rather think of it as a portfolio. So my good mortgage broker friends will actually help me evaluate the strategy. They are looking at their borrowing capacity, not just for the immediate purchase, but also in terms of, okay, after we do this, what is the borrowing capacity looking like for the next one? Because, going back to the statistics whereby I shared that having the 20% people get stuck with one or two is for a reason, because they either are not really getting the benefits what were told to them, or it's not working for them, or they're getting stuck with their borrowing capacity. So having that kind of a very clear strategy, very clear thinking, being aware of the roadblocks that what might happen or what might not, I just bring it in forefront of the discussion. Though someone is looking to buy only our property, of course, we'll be buying only our property within the next few months. But my approach is that, okay, how do we plan for the whole thing? It's like the example that I talk about is building a tower, a 12-story building, right? We do not want to go and build one story and think, okay, now we are done, purpose solved. Let's come back later on, 3 months later on, 6 months, and then we'll put another story. Then we'll see the resources, then we'll think about the third story. To me, it's a kind of a blueprint. The strategy is blueprint that, okay, we want to put a 12-story building. That means how deep foundation we have to dig, how much, the structural engineering or whatever we have to do has to be a forefront of the planning. Typically, it's like a Lego block, like we don't want to put a trapezium and, a sphere and then think about putting a slab there as a rectangular block. We have to be very mindful what's our strategy from there. So that's what I talk about. Let me know if I missed anything, any aspect of your question there.
No, I think it's perfect. And I think, this kind of leads into the common debate about cash flow or capital growth. And I think, you've kind of touched on that already with the cricket analogy is, you've got your batsman and you've got your the baller, the baller. And, you're kind of mixing that portfolio and getting different properties to suit different purposes. I think, there's a couple of other people out there and other podcasts that I listen to, and they're sort of heavy on that sort of cash flow side and kind of, just buy one or two really good assets and let them grow over time. How do you feel about sort of those other strategies or only, if that's what someone wants to go down, if a client came to you and said, look, I only really want to get one or two expensive assets and just let them grow over time. Is that something that you would consider for them, or are you very strong against, getting that balanced portfolio and continuously building, continuously expanding that borrowing capacity and growing in that mindset?
I'm not against it. Like every client have their own notions around it. But I'll be best suited for a person who's trying to build a portfolio. Because at the end of the day, even a person who's trying to buy an asset to get the cash flow, my question is like, would that be enough for them? So as I said, in the beginning, that it's more about the mindset as well. Like as long as we are very clear on our objectives that yes, the cash flow is all I need, and the cash flow is looking like 15 grand or 20 grand, and this is all I want from my property investing, that's fine, perfectly fine. But if that's really the right answer, maybe or maybe not, I don't know. So it's a journey. As I said, like every individual is different. Every person has their own notion about things around them. And I respect that. Everyone has their own perspective. They have different experiences. I'm just there to pose questions. So that to me, it should be more about making informed decisions. Today, they might say that this is all I want. I can tell them from my own experience, people will say something like that. After a couple of years, they might start saying something else. Hopefully, the person that I'm talking to is not of that same type. If they are, that's perfectly fine. Then it's not perfectly fine. That's imperfect, because then I'll be talking to them like, why, what happened? But if they say, no, we totally agree, we know what we are doing, or we are looking for a bargain or for a property of this kind of attributes. Yeah, so over there, I feel just that I'm underutilized in what I can serve them or what I can do for them. And most of the time, I feel that, as I said, it's a journey. Some people might be really ready with the portfolio theory or thinking about it as an aim. Like it's to me, it's not the end of the goal. Like it's like buying a property is just a means to get somewhere. So we should not really too much emphasize on the property investing journey, but rather what we want to get out of it. And the clarity in the vision of that is super essential. So I'll talk about that too. To your point, whether it's a cash flow versus equity, it's just a portfolio thing. It's a cricket like a cricket team. It's more about the balance of the team members. Like every team members have a role to play, and for a team to succeed, it should be more of a harmony. Like one hand knows what the other hand is doing as well, kind of thing. So having that kind of trust. Probably going in the different direction here, but every property has a role, and overall portfolio is that what matters. The portfolio has a lot of benefits. For example, like if I'm holding a big, two rich assets of properties, in northern beaches or eastern suburbs. Now the challenge is that if one tenant leaves the property, all of a sudden I have a 50% vacancy rate in my portfolio of two properties. Whereas when I have 10 properties, even when two tenants leave at the same time, which is probably unlikely based on the statistics, even if two people leave together, as in there are two vacancies in my portfolio, that is still only 20% vacancy because I still have tenants in my 8 properties. So kind of these kind of discussions like, okay, are you happy with 50% versus 20%? Those are the things that I talk about. At the end of the day, money is money. I'm not discriminating money coming from property that whether I would like to live in or I don't want to live in. Doesn't really matter. Like money is money. I don't discriminate.
Yeah,
so it's just more about the journey.
Yeah, you're buying the numbers, aren't you? You're not buying the property.
That's right. And also like to me, it's about risk mitigation strategy. Like two properties in the similar demography has more, chances to go up together, at the same time chances of going down together. But if you have a diversification built in, hopefully we have done the right analysis on the diversification. So the correlation coefficient actually helps to smoothen out the end result of the portfolio. So in my portfolio, for example, like the couple of properties which have been doing perfectly great until late last 2 years. And the other few properties were not really doing too great. But now things have turned around. Now my Southeast Queensland properties are holding up very well than what I could have seen for the Sydney property market. So So the diversification helps me mitigate the risk. Like I'm embracing them. That actually helps me sleep perfectly fine in the night as well. So as I said, it's not just the end goal, it's also the journey that we have to enjoy.
Yeah,
So portfolio has a lot of merits.
the thousands of submarkets within Australia all go through their different cycles at different times. You just got to, and that's why that diversification piece is so handy, is having different properties in different cycles, and being able to leverage in some areas, and then, just holding in other areas, and then going again and working your way through the cycles like that. It's great. So the listeners to this podcast are kind of the younger generation, either got, their first or second, or looking to get into their first investment property. What would you suggest to someone in sort of that position where they're either established or about to get into their first? They've probably got a budget of about 500,000 or something like that. Would you tell them to go to a diversification piece straight away? Is there, certain areas, is there a certain state that you'd like to get into first? I mean, how does that first sort of 1, 2, or 3 or third property play into the role?
Sure. So to me, the first, second, and third have the most significant impact on the overall portfolio. Going back to the same analogy of tower, unless we put over the foundation and the first story and second story perfectly fine, you might not be able to build up further on that. It's not just the architecture of the building, but it's also about, like how banks perceives us as an investor. If you're a chain investor, we really need to be mindful of what a credit authority person, as in the bank lending policies, are looking at our portfolio, our risk appetite, because banks are in the business of lending money. They really want to lend money because that's their business. They borrow cheap at a cheaper rate, and then they lend it to people like investors. So they really want to invest, they want to lend, but at the same time they have to be mindful of whether they will get that money back or not. So the point I'm trying to make is money is always available, one way or the other. How do we go about de-risking? It really depends on how we are putting our structure of our portfolio, as in like the early purchases. We don't want to be stuck or be limited by what banks are doing. So for example, like the kind of conversation that I have with the people who are trying to take advantage of the government policies on the first home buyer, nothing wrong with that. Emotional appeal to buy your own home is entirely different. You can't really put in a dollar figure. But I just asked them the question, like, have you considered this to go for your investment property first, build your portfolio so that when you're buying your own home, you can pay off with your cash that you build up? Because the definition of bad debt or good debt, that's where it is coming up as, like investment property is still an asset because it gives you money, whereas a home is kind of a liability from that definition. So that's where I'll be talking about with regards to where they should be going forward to. My take, Jordan, is that we are not going to buy the whole town. We are not buying the whole New South Wales. We are talking about a specific deal at the time whenever we are buying. So it comes down to the deal numbers. Of course, doing a top-down approach, there's always a benefit of thinking on the lines that, okay, whether, Victoria is doing better than New South Wales or Southern Australia, probably we should go for that. Macro factor-wise, yes. But at the end of the day, we still have to pick the right asset in that state or city or suburb or LGA. So what I do is basically I talk about the long-term fundamentals, because at the end of the day, for any investment asset, it's all about supply and demand, because that will define the price of it. Not just today's price, but also the price of the future, the forecasted price of that, which will define our profit out of it, which will define the equity that we are building in, that will define how much easily we can borrow money from the bank again. Because we have to show the credibility, and the credit will actually approve our loan. So my take on the first few purchases is all about capital growth or being able to generate that equity. We make money when we buy the property, as we all know, right? So the location is the key, as in like going in those areas which are about to boom. So the pressure is cooking there. It just not has really taken off. So there are quite a few parameters that we look at. like just as an example, like vacancy rates, days in market, vendors discount, and the likes. There are quite a few actually. And that will tell that, okay, like uh, why or how pressure is cooking up that the price will go up from what it is being projected today. The challenge that I found is that people talk so much about the hotspots. People talk about, okay, where we are going to buy or where experts are buying. It gives that kind of herd mentality behavior. And my tip would be to stay away, or rather be cautious of getting a lead like that and just buying on the back of that without really verifying it. Because at the end of the day, it's the growth of the property that matters. And we really need to make sure that it does better than the average of that area, as in of that locality, and we are able to buy under the market value. So there are quite a few components there, like in terms of researching which area to go for and then finding the deal. And the key thing here is that be always cautious of what type you're buying and how we can get the price under the market value. So it actually begs the question, like how do we define the market value? Because it's such a inefficient market. No two properties are same unless, like even the units in the same block are not the same because of their orientation or their pricing or, So it's very essential to have the independent research or being able to work out like what the pricing of that. And before that, I would say like, okay, so I'll probably start again. So first of all, the key thing should be, it should be matching with your strategy. So have an investment strategy. It's like having a plan, having a blueprint. Just don't go and build one story and second story, put second story on that. Have a strategy. Strategy will define what type of the property, what budget we are looking for, and the macro factor will define what location we should be going for. So first, right strategy, then the right location. Then we talk about the right property over there. So it should be the right property in terms of the numbers specific to that deal, that property that we are buying. What scope we have, whether we can add some value, like whether we are doing some structural renovation or just cosmetic or even just a development potential, whether you go as a developer on your own or not, but maybe some person later down the line as a developer might actually value the property accordingly. So, and then it comes down to the pricing of that. So when we know it's the right strategy, right location, right property, then we talk about negotiation and get the price. What I've seen people doing is that people say, oh, this property is going for 10,000 cheaper. I should go and buy it. And like, price doesn't really matter. In the scheme of things that we're talking about, whether we bought a property, right property, 10,000 expensive or 10,000 cheaper, doesn't have a play. So my advice is don't be too excited about the price discount that we see over there in the market. I'll repeat because I emphasize a lot on this. Have the right strategy, pick the right location, and the right property. Of course, if we can get the better price, much better.
Yeah. I think you're spot on. I think you touched on it before. You're making money when you buy, and coming down to asset selection, as you say, stick to your strategy and then branch off that. Know what you want to buy, what price point you're looking for, and then stick to that strong asset selection. It's not about can I get something in the same vicinity for cheaper. There's a reason it's cheaper. There's a reason there's less demand for it, and all of those factors, as you were talking about, come into play. So I think it's really critical that you've gone down that asset selection role along the strategy. I think that's awesome. And for the people that are kind of moving into those next stages, they've kind of got the first, the second, and as you were saying before, I think it's even 95. You were saying 90. I think it's even up to 95% of people get stuck on one or two properties. How and it's generally because they're sort of maxed out at their borrowing capacity, or there's some sort of resistance there. They can't break through, or they're finding it hard to get to the third or more. If someone's listening to this podcast and they're kind of in that situation right now, is there a way to get out of it? And how do they sort of move on to that third or fourth property?
I think, Jordan, that's very, very subjective. I can only say that sit with someone who has done it successfully, who can show what has gone wrong without really looking into the individual circumstance in the portfolio. It's very hard for me to say that. All I can say is that when I start, like when some client comes on board, or even without that, like I actually offer a free consultation whereby I sit with them, understanding their circumstances, as in like what they already hold, and then coming up with the ways if there's any potential for them to do anything. Sometimes, on the other hand, like Jordan, what I've realized is that people get so excited, like they have made money in their two properties, and they're like, no, I want to buy the third property now. And my role over there is to slow them down. It's like de-risk your portfolio, don't over leverage. As much as I love leverage, don't get me wrong, it has to be measured. It should be something that we can actually take on, with our eyes open. So to me, just don't rush into the third or fourth property unless knowing that this is the right decision for them. So sometimes waiting is the right strategy, like do nothing could be the strategy for the time. So the point I'm trying to make is it's very subjective. It's very much dependent on where they are in their journey. Like what are the reasons why a bank is not lending them money? Is it because of their income or their, like we talk about 5 C's as a mortgage broker would talk about. It's roughly like credit, collateral, character, the deal. So we can look into it. It might be that they're actually holding a lemon over there in the portfolio. We might have to, evaluate whether it's the right thing to hold, because sometimes we have to cut our losses. Sometimes it's not just about, like for example, like if a property is giving 3% capital growth or 4% capital growth, sometimes it might be worthwhile to bite the bullet and swap it with something which gives 7%, 8%. I'm not saying there's a promising 7-8%, but it's all probabilistic model. Like the likelihood of a property growing from here, if it is hurting on our cash flow, it's hurting on the capital potential growth. What's the point of holding it? Like in our stock market, the two regrets that I've heard from the traders is they have sold their winners too quickly, or they're holding their losers just too long.
Too long.
So we have to be just mindful of that thing. Of course, transaction cost is very high in property market. So we have to do justification of a cost benefit analysis on that. And most of the time, as I said, like it might be worthwhile to just wait on that or go a bit more active. So for example, when I was buying my third property, my banker told me fourth is the last one that I will be buying. So I had to go think of a property whereby I can have a bit more active strategy. I added up a granny flat to boost my cash flow. But when I did that, I did that with the intent that I can actually subdivide it and sell it separately. So that was a booster from the capital growth perspective as well, improved my cash flow. That for next 3 purchases, banks were perfectly fine until I stumbled on the same thing. Okay, after 7th, you can't buy this 8th one. So that happened. Like after 8, this is the last one. I bought another one, then another one. Even when I bought my 14th property, they were like, this is the last one you would like to buy. Then it's more about having a plan, having a strategy, being very mindful. And, sometimes when banks are saying no, they are actually doing it for the protection of the consumer only. So we have to be mindful that banks are our friend. They will lend money because of their business. But at the same time, call it regulator, ESEC or APRA, whatever, it's all about consumer protection. It's not just about the economy. It's also about consumer protection, like the hardship that one has to go through if something is going wrong. Leverage is high. We have to be very mindful. By paying 12%, 10%, we can have the whole exposure of the property. In the markets like this, when we talk about the media, that market is dipping for next 15, 20%, we might be, wiped out straight away. Not just the property purchases, but the other assets behind it. So the point I'm trying to make is, yes, there's an opportunity to make money out of it. But I've seen people losing money as well. So one has to tread the waters very carefully. Do it with someone or do it on your own only when you know what you're doing. Don't follow the herd behavior is the advice that I tend to give to people.
Yeah, no, that's great. I think, you've walked us through how you're de-risking that sort of scenario anyway throughout your process, through the diversification and all that sort of stuff. So, they're generally the questions that I roll with most people. And I think, you've covered them along our conversation anyway, which is fantastic to hear. And again, I love the fact that you're telling people that, okay, just wait, I know you want to buy again, but we can hold off, grow some more equity, get a bigger deposit, and we can get into a better asset. Or, you're not just consumed with, as some buyers agents might be, is just buying a property, and you're getting the commission along the way. And I think that really reinforces how much emphasis you put into the strategy and how much emphasis you put into what you get out of your clients or what you give your clients as a product. It's the journey. It's not just the commission. And I love it. I think you've summed up everything pretty phenomenally today. As I just said, I tend to run through these questions, but I think you've answered all of them pretty much throughout the process. So thank you so much for that. Is there any final advice that you'd like to give any of the younger generation in building their portfolio or getting to the point where you have so far?
Sure. Now, what I would say, first of all, I'll touch base upon the point that you made, like what buyer's agents do typically. I won't comment like why people just force upon the property purchase, but to me, personally, I build my wealth from my own property portfolio. My focus is on education. That's what I really wanted to do. But I've also seen that people tend to go and attend so many seminars, so many coachings, and it's only a very handful of the percentage that actually take action. And what I realized that if I just run the educational seminars out there might not mean much, because at the end of the day, if they're still stuck with the half knowledge and they can't really act on it, I'm actually doing a disservice. So buyer's agency is more of a second thought or a second product that actually came out of that. Like if for the people who really want to act on it, whom they should go with, because I've thought that maybe like I have been doing it, so I should offer that as a service. So the point I'm trying to make is that I'm very much prime focus of me in this business is about education. And I really want to keep it, without any dollar sign there. So I'm very much into education, like because that's what I realized that we are missing in the system. Like people are throwing seminars with the intent of commercializing it. Whereas what I'm trying to do, again, not everyone is like that, which I just described. So what I'm trying to do is like I'm educating people and at the same time answering that question just in case if they need to act upon it. So I'm going with a very open mind that if it is not right for the person, my education should actually hold them to not proceed further. So I thought maybe just clarifying on that, like, and respecting other buyer's agents out there as well. So this is what they do is great, because what buyer's agents actually do is they do all the running around, get the best deal, and they're very good buyer's agents out there. So huge respect to them, because as I said, like the whole industry is biased towards the selling agents. They are the professionals trying to representing the seller. But the buyers are actually underprepared, under-resourced. And because of the emotional trauma of buying a property, they are taken advantage of if they are not represented by a professional buyer's agent. So if somebody's trying to work it out, I would say like buyer's agents are worth their salt most of the time. So it's good to get hold of one of that person to do the job. Regarding the final advice, Jordan, I would say have a clear strategy. Just don't jump into the property investing. Don't be like 90% of the people who just get stuck with one or two properties. There's a reason why less than 1% people make to the portfolio of significant size. And they're very clear-cut differential points there that they are able to do it. And the key thing is to have the right team. The right team, the right mindset, and just going with the flow then, like having a plan and then following through the plan. So education is the key.
Yeah, I think that's super important. And I too am a big advocate for buyer's agents. Like I love them. I've used one on my most recent purchase, and they actually do the hard work for you. They've got their feet on the ground. They're understanding. So I think using a buyer's agent just to buy one property, they should save you more money than it is to use their services. So, if it's buying a better asset that's going to grow over time, they're going to provide more benefit in suggesting a better asset than the cost it is to use them. So I think that is super important. I think, thank you for clarifying that, because that's a big point. And for finally, because you've got such a big emphasis on education and, you are trying to help others, as you said before, you've been busy chasing up people with your workshops and all that sort of stuff, which I love. And, we were even having a conversation the other day and you're saying, I don't charge for my workshops and I don't charge for the follow-ups and all that sort of stuff. And this is the stuff that I love. This is the stuff that I'm trying to do with the podcast. It's just an easy place for someone to come and listen and have listen into a conversation about property. So I absolutely love it. And for the people who are interested in coming along to one of your workshops or just getting some more information from you, where could they find a resource or a link or something like that?
Sure. So my workshops are very much publicized on my website. Of course, I try to post it out on social media like LinkedIn and Facebook. So if any one of you would like to get on to the workshop, register your interest by going to my website, getrare.com.au, spelled as getrare.com.au/workshop. So I intend to run them on monthly basis. So the next one is on 7th of October. It's free and online, and it's a Wednesday evening for 90 minutes or so. Yeah, so more than welcome to come along. And it's a fun journey as well, because I talk about the philosophy, I share my own experiences, I talk about the case studies, like scenario analysis, and of course, there's a lot of follow-up questions, which I'm happy to take even on a one-on-one basis, yes, later on.
Yeah, I love it. Well, you've been an absolute killer today, Rasti. I really appreciate you coming on. And in fact, because of your history and your research and your degrees and everything else, I'd love to get a little bit more deeper with you at some point. I think, today's been really good sort of strategy, the plan, all that sort of stuff. But I'd love to get deeper with you. So I'd love for you to come back on it at some point if you'd be up for it.
I'll be more thrilled. This is my purpose. This is my motivation now, to help people to get their own journey. And if I can contribute in one way or the other, I'll be very pleased.
Beautiful. Well, thank you so much again for your time today.
Thank you so much. Thanks for this opportunity.
I wanted to say a massive thank you again to Rasti. It's always very insightful to listen to other success stories, learn where they started, how they did it, and how we may be able to replicate it. I'm always looking for more guests to come onto the show. If you're under 30 and have one or more investment properties, whether it's good, bad, or ugly, I would love to talk to you about it. Even if you're interested into getting into the property sector, let's have a chat. The main focus is to help other soon-to-be young investors with tips and tricks along the journey, learn from the mistakes that we have made, and ignite the fire to set themselves up financially for the rest of their lives. If you're interested in sharing your story, you can go to jordandeong.com/podcast, where there's a podcast inquiry button at the top that will guide you through the next steps. If you want to see what else I'm up to, you can go to YouTube and type in Jordan de Jong, where you'll find the Smashed Avo Property podcast being hosted on YouTube, and plenty of other content that I'm putting out consistently. If you're keen for more content like this, make sure you subscribe, and please leave us a review with any feedback for future podcasts. And until next time, happy house hunting.